Anil invests some money at a fixed rate of interest compounded annually. If the interest accrued during the second and third year are, right, in these years, specific years are 806.25 and 866.72, the interest accrued in INR during the fourth year is nearest to what, right? So in the interest and growth lesson, we've seen for compound interest, there are two things which are going to grow at the rate of interest. One is the amount, right? Amount is always going to grow at the rate of interest, and so is going to be the yearly or annual interest, right? Every year's interest under compound interest is also going to grow at the same rate. So second and third year we have, and the fourth year we have to find. All right, so 806.25, 866.72, and what is this going to be, right? The thing is very simple. How does it work with amount? Every year we are multiplying with 1 plus r by 100, right, to get this. And this amount, the end of third year's amount with 1 plus r by 100. It's the same concept over here as well, right? It's the same concept over here as well. So we have to be multiplying with the same value. Now, how do I find the value we're going to multiply with? If I divide these two, I can find that value. So I will divide these two and to find this value, and I'll take this value and multiply with this, which is the same as this, right? This divided by this gives me this. And that value multiplied with 866.72 is going to give me the fourth year's yearly interest, right? So this is one of those questions where I have to explain a lot to you, but the solution per se is going to be very little, right? Very little, or very minimal, right? So let's look at that right now. So 866.72, if you know the concept really well, right? It's very simple. Divided by 806.25, sorry about that, 25, and then we have found the multiplication factor, and that is the same which is over here as well, 1.075 into this. 7.5% is the yearly interest, doesn't matter. Just take this value, just into 866.72, and that's it, we are done, right? Into 866.72, and what's the value? 931.725, and the closest over here is option 4, and done, right? This is one of those questions where there's very little for you to do. You don't even need to write all of these down. If you're conceptually clear, this is growing at the same rate. We have one value, we have the next one, we need to find this. Divide this, find the multiplication factor, take that and multiply it 866.72, and we are done. These are the questions where you could take about 30 seconds or 40 seconds to read even, right? 30 seconds to read, understand, 20 seconds to answer, 10, 15, 20 seconds, right? Within a minute, comfortably within a minute, you can answer and go. Raj invested 10,000 in a fund. At the end of first year, he incurred a loss, but his balance was more than 5,000. Okay. This balance, when invested for another year, grew, and the percentage of growth in the second year was 5 times the percentage of loss in the first year. Okay. So he had 10,000, right? And then we're going to multiply it with 1 minus x by 100. There was an x% loss, right? Let's call that x% loss. So there has been a loss over here. Let's call that x percentage. This balance, when invested for another year, this entire balance has been invested for another year, and the percentage of growth now was 5 times x%, which is 5x%. It's grown this time around by 5x%. Okay. If the gain of Raj from the initial investment over the 2-year period is 35%, it's grown by 35%. And what is asked over here? The percentage is what? Percentage of loss. We need to find x over here, right? It doesn't matter whether it's 10,000, 40,000, 70,000. We can take it as 100 rupees, and there has been a 35% growth to become 135 rupees. That's it, right? So how do we work with this? How do we simplify? You can just first divide over here, and we get 1.35. Now, for us to multiply, open these two, expand this and simplify, cancel, and have, a quadratic over here because of x by 100 into 5x by 100 and all that, it's a painful affair. We have options over here, right? Best is to substitute and conclude. A couple of observations over here will help, right? One is, we are getting 1.35, product of 2 decimals, right? We're going to get 2 decimals over here. One is 1 minus some decimal, and another is 1 plus some decimal, is giving me 2 decimals. So therefore, it should be something like a 0.9 into 1.5, or it could be a 0.8 into, if it's 20%, it could be like, it goes up to 2, right? It's shooting past. What if it's like a 5% reduction? Just think about it. If it's a 5% reduction, then on the other side is a 25% increase, right? 5 times 5 becomes 0.95 into 1.25. That's going to give me 4 decimal places. I have only 2 over here, right? So look at 5, right? This is for 5%. If x is 5%, and 10 over here, right? If x is 10 or 10% or 10, right? X percent is 10%. Then we get 0.9 into 1.5. I think at this stage, a lot of you would be knowing 15 tables. 9 15s are 135. Straight up, we can mark it and keep going, right? It's just my explanation is long over here. If you understand these, you're going to be answering these very, very quickly during the exam, right? Once again, speed during the exam, right? In the CAT exam is not going to be from reading it fast and starting to write all the steps. It's to observe and then go in for the quickest approach. That's it. Spend more time in reading and observing and spend as little time. That will result in you spending as little time as required to get the final answer. Now, just a quick thing for those of you who are not too clear with this, right? When x is 10, if I substitute, what do I get here? 1 minus 10 by 100 into 1 plus 5 into 10, 50 by 100. This is 1.9 and this is 1.5. You multiply these two and you're getting your 1.35. When I substitute 10, it works out, and therefore that's the answer. Bank A offers 6% interest rate per annum, compounded half yearly. Bank B and Bank C offer simple interest, but the annual interest rate offered by Bank C is twice that of Bank B, right? Till this point, it's quite a bit. So the best way to go about is going to be to take some notes over here. A, B, and C, what do I have? 6% per annum, okay, and compounded half yearly, right? So immediately write this down as 3% per semi-annum, compounded half yearly, okay. B and C offer simple interest, okay, but the annual interest rate offered by Bank C over here is twice that of Bank B. So if this is R%, right, we'll just write as R, then this becomes 2R, right? 2R, percentage is understood. Now Raju invests a certain amount in Bank B for a certain period, and Rupa invests rupees 10,000 in Bank C. So the principal, 10,000 in Bank C, and Raju is investing a certain amount. Let's just take that to be P over here. We don't know how much. Okay, Bank C for twice that period. Okay, twice that period. What does it say? Raju invests a certain amount of Bank B for a certain period. Okay, B for a certain period. Rupa is investing in 10,000 this in Bank C for twice this period. So if this is N, this is going to be 2N. Okay, so time. Okay, we're done with that as well. The interest that would accrue to Raju during that period is equal to the interest that would have accrued had he invested the same amount in Bank A for 1 year. Okay, again, it's quite a bit over here. The interest that would accrue to Raju during this period, right? Raju is the person who is invested over here, right? And the interest he's going to accrue over here is equal to the interest that would have accrued had he invested the same amount in Bank A for 1 year. So in 1 year, what is the interest over here? Interest rate for 1 year, 3% semi-annum compounded half yearly. You people should get comfortable right now. You don't need to be sitting and doing 1.03 whole square and all of that. You need to know under simple interest, it's going to be 6%, but under compound interest, for one more time period, right? One extra, it's going to be 3% of 3%. 3% of 3%, that is coming to 0.09, right? So 6.09 over here becomes the effective interest rate, right? Interest rate in 1 year, okay? So once again, we can expand this and see, you're going to get 1.0609, which means 0.0609 or 6.09% becomes the rate. Going forward, you should know certain values. 1.04 square means, what's it? 4 times 2 is 8%, right? Is 8%, and then 4% of 4, which is 16. So this would be 1.0816 and so on, right? Or another way to look at it is the interest earned over here is going to be 4% plus 4% plus 4% of 4, which comes to 0.16%, and therefore 8.16%. Once you know these well, you don't have to rely on the calculator much. You'll be able to get these very quickly. Okay, so what's given over here is 6.09% what you earn in 1 year. That is the rate, the interest that would accrue to Raju during this period, right? During this period is what? NR, right? N into R. That's what you're going to get on whatever the principal. So NR is the rate, and that is coming to 6.09%. Okay. And what about C over here? What's the rate over here? Interest rate is nothing but 2N into 2R, right? Which is 4NR. Why am I just multiplying these two? Because it's under simple interest, right? Whatever the principal, the rate is going to be now time period into the rate over here, 4NR. If NR is 6.09%, 4 times NR is going to be 4 times this, which comes to 24.36%, right? So 24.36% is what I'm going to be earning on 10,000 rupees. What is 24.36% of 10,000? It's 2,436. Option 2 is the answer here. Alex invested his savings in 2 parts. The simple interest earned on the first part at 15% per annum for 4 years, okay, is the same as simple interest earned on the second part at 12% per annum for 3 years. Let the 2 parts be A and B. These are being equated right now, right? How is it being equated? 15% for 4 years, right? Every year is 15%. It's simple interest. For 4 years, going to be a total of 60%, right? Don't need to do P, N, R by 100 and all of that. Just think about it logically. 15% each year in 4 years, it's 60%, right? 4 into 15. 12% over here for 3 years. Each year is 12%. 3 times you add up 12%, you're getting 36%, right? 36% of B. Now, what is A by B going to be over here? Let me write that clearly. It's going to be 36 by 60, right? 36 by 60, if you divide by 12, you're going to get 5 and 3. Do not directly write it as 5 is to 3 is A is to B. That's, that's classic mistake which people do. Always write it in the P by Q form, right? A by B is 3 by 5. It's in the ratio of 3 is to 5, okay? The percentage of a savings invested in the first part of 3 parts over here is what? Of the total savings. So if A and B, each of them are going to be 3 parts and 5 parts, the total is going to be 8 parts over here. 3 parts is what portion of 8 parts? 3 by 8. As a percentage, you should know as 37.5%. Shouldn't be multiplying and wasting time because we have it in the percentages lesson module 2, right? The table over there contains that 3 by 8 is 3 times 12.5%. 1/8 is 12.5%. 3/8 is 37.5%. These are the places, if you know these, you prepared well, you answer them very, very quickly. Mr. Pinto invests 1/5 of his capital at 6%, 1/3 at 10%, and the remaining at 1%, each rate being simple interest per annum. 1/5 of the capital, 1/3 of the capital, and I have a percentage symbol over here. Let the total be some value which is a little friendly. I need 1/5 and 1/3, should be divisible by 5 and 3, 15. But I have percentage, 6 by 100 and all of that. Let's make it 1500, right? So 1/5 of his capital, right? 1/5 of this is going to come to 300. 300 has been invested at 6%, okay? 1/3 of this, 1/3 is 500, and that's been invested at 10%. Now, a lot of students, might make a mistake over here thinking that is 1/3 of the remaining. No, it's not. It just says 1/3 at 10%, 1/3 of the total. If it would have said 1/3 of the remaining, then of the remaining 1200, then 1/3 becomes 400. That's not given over here. Do not make a mistake. Be careful. 1/3 at 10%, and the remaining now 800 is done. The remaining 700 is being invested at 1%. Right? What's the interest earned over here? 6% of 300. 6 3s are 18. Right? If you take friendly values, the calculation is quite simple. Right? 50 and 1% of this is 7. You add this up and you get a 75. 75 is what we are going to make each year because it's simple interest, right? There's no interest on interest. The minimum number of years required for the cumulative interest income. 75 each year. In n years, it becomes 75 into n. That's the total interest, cumulative interest income from these investments to equal or exceed. Should be equal to or greater than the initial capital of 1500, right? 75, if I divide over here, I get a 20. N is greater than equal to 20. What is the minimum number? Minimum value possible for n is 20 because it's greater than or equal to 20. In a coastal village, every year floods destroy exactly half of the huts. After the flood water recedes, twice the number of huts destroyed are built. Okay, you have some number of huts. then there's some destruction, then there's a rebuilding. The floods occurred consecutively in the last 3 years, namely 2001, 2 and 3. If the floods are again expected in 2004, the number of huts expected to be destroyed. So you had a certain number of huts, then there's destroyed, then there's rebuilding, and then you have final number of huts, which becomes the beginning for the next year. And that process continues. There are no absolute values here. Everything is in relative terms. We need to check which of these is true. So we need to assume a value and start. Now what's happening over here? We need to delete half and we have to add back something, right? So a lot of times we're going to be multiplying with half. 1 by 2, 1 by 2, 1 by 2. Let's take it as like, 3 years at least. 2 cube is 8. Let's take it as 800 huts, right? The beginning, at the start, we had a total of 800 huts. That could be a good starting point. 2001, the beginning. And then we had some huts which were destroyed. And then there was a rebuilt. Some were rebuilt. And after that, we have the end, right? End of that year. How many huts were there, right? So let's just start with the values over here. Let's take it as 800 as we discussed, and the rationale behind that is simple. Half, 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 right? 3 times there's going to be some destruction, half. You can always take a smaller value if need be. 2 zeros is good enough for you to understand, and 8 over there is a 2 cube, so it should not get to decimals, right? Half are destroyed. So 400 are destroyed, and let's put it as a minus 400 because it's destroyed. And after the flood water recedes, twice the number of huts destroyed are rebuilt. Twice of this are rebuilt. We have plus 800, right? Okay, 800 plus a 400. At the end, we're going to have 1200. That's going to be the beginning over here. This process is continuing. Half are destroyed. Twice of this are rebuilt. 1200 plus 600, 1800 over here. 1800 we had to begin with, and then minus half of that, and then twice of this is rebuilt, and then we have 1800 plus 900, which comes to 2700. 2700 to begin with, and then a minus half of this, 1350. I think we stop over here because the number of huts destroyed, expected to be destroyed in 2004, is this number 1350. I put a minus over there, but it is going to be just 1350. We need to see which of these is true. Is 1350 less than, right? The first one, less than the number of huts existing at the beginning of 2001. Number of huts existing at the beginning of 2001, 800. Is 1350 less than 800? Wrong. Next one is 1350, right? The question asking, is 1350 less than total number of huts destroyed by the floods in 2001 and 3? 1 and 3 put together, 400 and 900 over here. Is this less than 1300? 1350 less than 1300? Definitely not. It's bigger. It's 1350, once again less than the total number of huts destroyed by the floods in 2 and 3 combined. That is 900 and 600 combined. That's 1500, which is true, right? Option 3 is the answer very clearly. Option 4, let's say we want to continue and see. More than total number of huts is 1350, more than the total number of huts built in 2001 and 2. Built, right? 800, 1200, right? Is it more than 2000? Definitely not. So option 3 over here is the answer. On January 1st, 2004, 2 new societies, S1 and S2, are formed, each with N members. Okay, S1, S2, and each of these societies have N members on Jan the 1st. Okay. On the first day of each subsequent month, S1 adds B members. Okay. While S2 multiplies its current number of members by a constant factor R. Both the societies have the same number of members on July 2, 2004. If B is 10.5 N. Okay. July 2nd, and this is January is the first month, right? And from there we are moving to every subsequent, first day of each subsequent month that's happening, and we are going up to the 7th month, right? How many months are we crossing? 2, 3, 4, 5, 6, 7, right? 7 minus 1, 6 times we are crossing. So over here we are adding how many members? B members, right? Each month. but B is equal to 10.5n. So we are adding 10.5n 6 times, right? 6 times over here. And what are we getting? 6 into 10.5n is 63n, add to n, and you get a total of 64n, right? 64n. This is equal to something, right? This is equal to, what does it say? Both the surveys have the same number on July the 2nd, right? What's happening on July the 2nd over here? What has happened over here? It multiplies its current number of members by a constant factor r. So you kept multiplying with r. How many times? Total of 6 times, which is nothing but r power 6. So 64n equals n into r power 6, and you can simplify. 64 is 2 power 6. You should be knowing at the stage. Cancel these, and r equals to option 1 is the answer for this question. Shabnam is considering 3 alternatives to invest a surplus cash for a week. She wishes to guarantee maximum returns on her investment. She has 3 options, each of which can be utilized fully or partially in conjunction with others. Okay, you could also do a combination. Option A is invest in a public sector bank. It promises a return of 0.1%. Okay, done. B is invest in mutual funds of ABC Limited. A rise in stock market will result, definitely is going to result in a return of plus 5%, while a fall will entail a return of minus 3%. Okay, if it's going up, it's good. If it's falling, it's bad. Okay. Invest in mutual funds of CBA Limited. A rise in stock market will result in a return of minus 2.5. It's working against, while a fall will entail a return of plus 2%. Okay, these two are working in 2 different ways, option B and option C. Option A is a guaranteed fixed return of 0.1%. The maximum guaranteed return to Shabnam. Guaranteed means it doesn't matter whether the stock market is going to fall or go up. This minimum is confirmed, right? Definitely you're going to get that if you go in for a certain combination or whatever. At this stage, the highest guaranteed return looks like 0.1%, right? The rest, there is a possibility of a decline as well. But if they're going to give a question like this in CAT paper, right? And this was the year when I wrote and go to my campus. I am Lucknow, right? So there's going to be there should be some combination over here which could give you something higher, right? That should be the thought process. So what is that possible combination? How could it work, right? So let's look at it. So form a table over here, right? To take some short notes, right? That's important first. What are the notes we could take? Let's say A, B, and C, right? A, B, and C over here. And if there is going to be a rise in the market and there's going to be a fall in the market, here it's going to be a plus 0.1%, plus 0.1% either case, right? Either ways, that's the return over here. In the case of B, if it goes up, it's a plus 5%. If it's a fall, it's going to be a minus 3%. Okay, linked to the stock market. What about C over here? It's minus 2.5% if it's a rise, and a guaranteed, not a guaranteed, I mean, fall will entail, pretty much guaranteed, right? That's what is given. You're going to get a 2% if it's going to be a fall. Now, if you're looking at a combination of these two, B and C, there could be a minimum guaranteed return, right? Now, if you're looking at A alone, it's a fixed rate, right? Which we have. Keep this aside. See if these two can be mixed in a certain rate, which is going to give us a guaranteed return. When is that guaranteed return going to be? When both of these are going to be equal, right? If you take it as X amount is invested, or B amount is invested in option B, and C amount is being invested over here, what are we getting as a return? If there is a rise in the market, our return is going to be, let me write it over here, 5% of B minus 2.5% of C, right? I'll write it as small b and small c is going to be equal to, right? If this is going to equal to this, there is minus 3% of B plus 2% of C, right? Just take a look at it. What's going to happen now? If we bring the B to one side, we're going to get 8% of B, right? Equals, take the 2.5 there, you get a 4.5% of C. And what are we getting over here is B by C. B by C is 4.5 by 8, right? Which can be written as 45 by 80. And if you simplify, divide by 5, you're going to get 9 by 16, right? 9 by 16. Now take it as this. If you're going to invest a total of 100 rupees, how is it going to get split? 9 is to 16, right? Total of 25 parts. If that is 100 rupees, it's going to be into 4. 9 into 4, 36 rupees for B, investment B, and 64 rupees for option C, right? 100 rupees if I have, I'm going to split it as 36 and 64, so that in both scenarios, whether it's a rise or a fall, my return is the same. Now, what I need to figure out is that minimum guaranteed return, or rather a guaranteed return, going to be more than 0.1%, right? If that is the case, if I know that it's going to be more than 0.1%, I know that either which ways, my return is going to get, my guaranteed return is maximized. Now, once again, some of you might be confused saying that, hey, I said minimum and why, what about this maximum over here and all of that, right? Look at it this way. Guaranteed means either which ways, rise or fall, I'm going to definitely get that, right? Guarantee is the minimum possible return. Where is it getting maximized, right? Is it just A or a combination of B and C? Guarantee is speaking about a minimum definite return which is coming in. Where is it getting maximized? Whether it's A alone or a combination of B and C. I'm saying with the combination of B and C, if both are equated, we know that that is definitely going to be there in both cases. And let's see what we are getting over here. So if 36 rupees is invested, right, and 5% of 36 is what? 1 by 20 of 36. Think about that. 5 by 100 into 36 minus 2.5 by 100 into C over here, which is 64, right? How much is this going to come to? 5 by 100 is nothing but 1 by 20. 36 by 20 is 3.6 by 2, which comes to 1.8. 1.8 minus 2.5 by 100, you can simplify and you get a 40. 64 by 4 is 16 and you get a 1.6. And I'm getting a 0.2. I'm going to get 0.2 in the other case also because I equated it. Don't need to once again substitute in C. So 0.2 I'm getting in both cases, right? Whether it's a rise or fall, with the combination for B and C in this specific ratio. So 0.2 for a total investment of 100 rupees, 36 plus 64. 0.2 return for an investment of 100 rupees means 0.2% is what I'm getting for sure. Option 3 over here becomes the answer. Now on to the next question. What strategy will maximize the guaranteed return to Shabnam? We found that already. The strategy to maximize is going to be 36 is to 64 B and C, 36% in option B and 64% in option C. Option 2 becomes the answer over here.